Corporate finance practice problem using OneNote. 7-year MACRS depreciation, 10-year cash flow, and net present value. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side and the practice problems down in the 1239 7 MACRS depreciation, 10-year cash flow, and net present value tab. Also note, when using OneNote, look at the immersive reader tool. Our presentations up top will be mirrored down in the text area with the same name, same number, and having transcripts that can be translated into multiple different languages and either listened to or read in them. Closing up the icon, we have the information up top, calculations then on down below. Another comprehensive type problem taking in multiple concepts that we've seen in the past. This time, however, we have the 7-year MACRS fixed asset and we have 10 years of cash flow, which outpaces the period in which the tax depreciation will then cover. So those are some of the newer components here. So we're putting down the $300,000 up front. We're going to be purchasing then fixed assets that will be depreciated. So taking that into consideration, we have to take into the tax depreciation consideration so that we can look at the cash flow related to the taxes, and then we'll then calculate our cash flow. We'll then calculate our net present value calculation. So up top, we have to first consider then the depreciation. Remember that when we look at our net present value calculation, we're typically on a cash basis. We are assuming the $300,000 is going down up front. So normally we would just remove the idea of depreciation because it would be allocating that cost over the time period that's being benefited on an accrual basis. But for taxes, we need to take it into consideration because that's when we get to deduct the amount related to this $300,000. We don't get to deduct it up front oftentimes, but have to apply it out in accordance with the tax code. Note that the tax code could change from year to year. They might have special deductions up top in the first year, like a 179 or special deduction, and the law could change, but we have to follow whatever we can in the tax code, and the general basis is this MACRS kind of depreciation oftentimes when you're looking at different types of depreciable business assets. So that's what we will assume here. And note that you have to then assign whatever category for depreciation for taxes. We'll apply that out. Also note that the kind of property that you have will determine the years in which it will be depreciated in general for taxes, unlike with the books. And you could end up with a situation like we have here in that the tax code allows you to depreciate it in a shorter time period than we expect it to actually be useful. In other words, depreciation in general we would assume we would want to depreciate it over the useful life of the asset. That's not necessarily what happens for taxes. We have to just follow the rules for taxes. So if I was to do depreciation for the book purposes, I would depreciate it over 10 years if I think I'm going to use this to generate revenue from it over the 10 years. But for taxes, we have to assign whatever tax rate is there or life is there. That means we're going to depreciate it for a shorter life than we expect it to actually help us to have a return on. So if we look at the publication, you can find this on the IRS website, irs.gov, irs.gov. We're looking at publication 946 for more information on depreciation. We're looking at table, in this case, A1, and the 7-year depreciation would be here. So you could use these rates if you would like to do your estimates. That might be a little bit faster. This is basically a double declining half-year convention that we will be using, although it will have the rounding oftentimes that will be applied. And you can see right here in these 3 years, it starts to even out the rate at the end. So we'll actually calculate that so we get an idea of how it relates to like a straight line method, and we'll estimate this. It won't be exact, but we'll estimate it so we get an idea of what the tax code is doing. So we got that in terms of the outflow. We've got these inflows that will be taking place, and then the tax rate and the cost of capital. Let's start with the depreciation. So MACRS depreciation, we're going to say that we bought this thing for $300,000. We actually put down cash, we're imagining, but for the deduction, we can't deduct the full thing up front. We have to depreciate it depending on the tax code. You know, they could have some special depreciation or 179, but this is the assumption we're making. $300,000 divided by 7, we got the $42,857. And if I compare that, that would be the straight line depreciation. If I divide that by the cost, the $300,000, we've got the rate of the 14.29% about. That would be about the straight line rate. And then if I times that times 2, we would get the double declining rate, the double declining rate of the 2857. You can also get there by taking 1 divided by the number of years, 7 straight line rate times 2, and get there at the 2857 about. Note that this is rounded. In Excel, I would use the full amount, whereas if you were going to the taxes here, you would have the half amount here. Notice it's half because it's the straight line rate because of the half-year convention we'll see shortly. But this 2449 or 2449 is closer to the rate. Or in other words, if you took this 14.29 times 2, you get our 28.57. So if I go back on over, but it's rounded, you can see that the rounding, that's one of the estimates that will happen when you're looking at the tax code. So we got the 2857, and then if we multiply that times the 300,000, so the 0.28, one more time, this is the 0.2857 about times the 300,000, we get about the 85,710, and again, note that there's rounding there, that's why we got the 85,714. And then we're going to take the half-year convention. This would be the rate if we use double declining. And then, of course, we have the half-year convention, assuming that even if we purchase this in January or December 31st, that we purchased it in the middle of the year. That's the general rule. There could be exceptions, especially if you try to abuse the rule by purchasing everything at the end of the year, like December 31st. There might be a change in that case. But in general, 85,714 divided by 2 would be the 42,857. Then if we continue this, and also note that that 42,857 is the same as the straight line, but it's not straight line, it's double declining with a half-year convention. That's important because when you go to year 2, you can't use the straight line or it will be wrong. We're going to pick the 28.57 about times the cost, 300,000, minus the accumulated depreciation, which is the 42,857. That's the 257,143 about, times the 0.2857 about, would then give us for the next year the 73,465. If we did this again, we would then say we got, and this is rounded, of course, because again, this is rounded to a couple digits. In Excel, we use the actual calculation here, and the calculator we are rounding. So then if I take this, we take where we were last time, the 257,143 minus the 73,469, we get the 183,678 times about the 0.2857 gives us about 52,478. Again, difference due to rounding. Continuing on to the next period, we're going to take then the amount of where we were before, the 183,673 minus the 52,478. That gives us a cost minus accumulated depreciation of 131,195 times the rate of about 0.2857 gives us then the 37,484 about, and then we have it here. We're going to say, all right, then we have the 131,195 minus the 37,484 gives us the 93,711 times the 0.2857 about gives us about the 26,775. And then the next one, we're going to be taking then the 93,711 where we left off minus the 26,775 gives us the cost minus the accumulated depreciation 66,936. But we're not going to multiply it this time because we're going to kind of mirror what the code does here. And you can see that here, that it's basically evened it out a bit in the last couple of years. So we'll kind of mirror that just so you can see what's actually happening in terms of the calculation. So it's a double declining method, half-year convention, and then they kind of smooth out the tail end here. So we're taking the same 26,775. I'm just going to take that same amount instead of multiplying times 28,57, and then we'll do the same thing. So I'll take the 66,936 minus the 26,775, 4161, but I'm not going to multiply times the 2857, but rather just take the same amount again. And then finally, lastly, we would then have the plug, which is standard for the straight line method, and that's what we need to finish this thing off in the last year, 4162 minus the 26,775 means we have the 13,387 left, that then being the plug. Note that we have 8 years here, even though we said it was a 7-year maker's property due to the half-year convention. So you could think about it as the full years here and then a half year up front and a half year at the end, even though the last year is basically a plug type of year. If I was to add up all the depreciation at the bottom, it should then add up to the cost, which was the $300,000. Let's try it out. 42857 plus 73469 plus 52478 plus 37484 plus 26775 plus 26775 plus 26775 plus 13387 is the 300,000. So we have the 300,000 there. We've allocated it out, even though we paid cash 300,000 up front is our assumption. This allocation is important because it has a tax impact, and the cash impact will have a cash flow impact. So now let's think about what the tax impact will be. We've got our cash flows. These are going to be the inflows that we expect from this initial outflow that we have up front for the next 10 years, even though we have the depreciation only going out and affecting the next 8 years. And that, once again, is due to the tax code not really tying into what we expect the actual useful life to be. We have to use whatever the tax code says, which doesn't have the same kind of logic behind it as doing this on a bookkeeping kind of basis, where we would probably try to use the full useful life of 10 years if applicable. That would make the most sense. So that means if we go down to our cash flow, then we're going to say, okay, then the earnings before depreciation and taxes is just going to be what we expect to receive as a result of this investment, which are these cash flows. X1 to X5, the first 5 years, 100,000. Second 5 years, we're saying 70,000. Just lining that up in a horizontal type of fashion. Then we'll line up the depreciation, deducting that out, allocating the cost for a tax basis, because that's the point at which we get the tax benefit from it. So now we're just lining up the same depreciations that we got up top, down below, under the cash flows in the proper years, subtracting them out. 100,000 minus the 42,857, for example, is 57,143. 100,000 minus the 73,469, 26,531. The 100,000 minus the 52,478, 47,522, and so on for the 10-year time period, noting that, once again, we ended the depreciation here, meaning we totally recovered the cost or depreciated the whole thing after 8 years on a tax basis, even though we expect these two 70,000s to be a benefit due to the purchase of the equipment. Once again, the depreciation period for the tax code not lining up to what we actually expect the generation of revenue from the use of the equipment to be, because that's not what the tax code is for necessarily, or not the full reason. So then we're going to say that the taxes would be calculated then on the income that we got here. So tax rate we're saying is 35%. So we would simply take then whatever we have there, the 57,143 times 0.35, giving us the 20,000 about here. Then in year 2, 26,537 times 0.3, giving us, hold on a second, 26,531 times 0.35, giving us the 9286. And then we take the 47,522 times 0.35, gives us the 16,632, and so on and so forth for the taxes. Note that the rate we're using here, although there's a progressive tax rate, meaning we might have multiple tax brackets we pay at, we typically might use the highest tax bracket given the fact that this is our next decision. Therefore, we're paying on the margin, basically being already in the highest tax bracket when we make this decision, most likely. But it could be more complex than that if, it's going to affect us going into another tax bracket or something like that. Then we have the earnings after taxes, which would be just subtracting this out. Earnings before taxes, for example, 57,143 minus the 20,000 taxes gives us the 37,143. The 26,531 minus the taxes of the 9286 gives us 17,245. The 47,522 minus the taxes of the 16,633 gives us the 30,889. Then we have the depreciation that we would add back in. The only reason we deducted it out, even though we paid cash for it in year 1, is to look at the cash impact, because it's a cash flow factor. We're looking for cash flow factors when we want a present value. So we'll add back the depreciation, the 37,143, plus the 42,857 is 80,000. The 17,245 plus the 73,469 69 is the 90,714, and so on and so forth. This then is going to be our cash flow. And notice again, we had no depreciation in year 9 and 10 because we had fully depreciated it by year 8. So this would be our cash flow. Now, this would be a similar point as though we had our prior presentations when we're looking at the net present value calculation for, say, a series of future cash flows. Now we've adjusted our series of future cash flows based on a more complex thing, such as taxes involved. And now that we have our cash flow, we can go from that point and simply calculate the present value on it. Again, you can note how this can be much more complex in terms of what happens in terms of a budget. If you're budgeting out into the future or thinking what might happen, you can present value the cash flows or think about what the cash flows will be and then present value them. Note, however, that when you're doing the present value calculation assumes all cash flows happen at the end of the period. So that, if you're looking at cash flows that happen in the middle of the year or something like that, then we make the assumption on the present value calculations that they happen at the end of the year, and that's just one of the kind of limitations of the present value calculation, just to keep in mind as you go through it. So now we're going to do our present value first in a horizontal fashion, then we'll do it in a vertical fashion, and we'll think about the IRR, internal rate of return, after that. So we're just going to take our present value numbers here, our cash flow. If we did it horizontally like this, then we might just imagine adding the present value just right below this. These are our cash flows. I'm going to assign the numbers up top for the years, 1 through 10 being the years. These are going to be the inflows, not including period 0, which we'll add to it in the second step. If we were to present value these, it would look something like this. So the 80,000 present valued using the cost of capital, 15%, which might be called the required rate of return sometimes, cost of capital, the hurdle rate. So you might hear different names for this, but it basically includes what we expect our profit to be. Therefore, if we do the net present value calculation and get to anything 0 and above, that means we have either met or cleared the 15% and may take on the project. Anything below 0, we may deny it. So the 80,000 discounted 1 year back at the discount of 15% is the 69,565. The calculation down below here, note that if you want to see this calculation in multiple different ways, like with tables or with Excel or with tables or with mathematical formulas, take a look at the prior section where we do that. If you're looking at a long problem like this, then even a test question would have to limit it if they're going to take away the calculator and or Excel, because you're going to have to present value each one of these, which would be a tedious task if you needed to do it by basically a mathematical formula. But if you want to know that, then take a look at the prior section where we focus in on that. If we did this in Excel, we'll take the present value of the rate, which would be that 15%. Notice it's an absolute reference noted by the $ before the B and the 17, so that when we copy it across, the cell will stay the same, comma, number of periods is 1. We're picking up this 1, however, in the cell reference so that when we copy it across, it will move to 2, 3, and 4, and so on. Comma, comma, because it's not an annuity, but present value of 1. Future value is that 80,000. Result 69,565. If we do that for period 2, the 90,714 present value 2 years back at the discount 15% is the 68,593. Formula, if we simply copied this over, would be present value of the rate, 15%. Note these cells are the same because they are absolute referenced with the $signs, comma, number of periods is now 2. Instead of typing or hard coding it in, we have a cell reference which moved from O10 to P10 here, comma, comma, and the future value would then be this 90,714, which once again, the cell reference you can see moved from O11 to P11. So then that would give us the 68,593. If we continued on with this, period 3, the 83,367 present valued 15%, back 3 years is the 54,815. The 78,120 present value back 4 years, 15% discount, 44,665. The 74,371 present valued 15% back 5 years, 36,976. The 54,871 present valued 6 years back at the 15%, 23,722. The 54,871 present valued 15% 7 years back, 20,628. The 50,158 present valued 15% 8 years back, 16,406. The 45,500 present valued at the 15% discount 9 years back, 12,934. And the 45,500 present valued at the 15% 10 years back would be the 11,247. Adding all the present values up, we get to the 359,551. Comparing that then to what we put down up front, period 0, which doesn't need present valuing due to it being in period 0, 300,000, means that we subtract these out, we get a positive 59,551. Anything above 0 would mean that we cleared our cost of capital, which is our required rate of return, we're saying here, of the 15%, and therefore may accept the project. So it's above the 15%. We don't know exactly what it is. We could calculate the IRR, and we'll take a look at that shortly. Let's just recalculate this using our vertical type of fashion that we've seen in prior presentation, looking something like this. We have periods 0 through 10, and we then are just going to list our calculations once again, this time with the outflow in period 0 as a negative number, the 300,000 that went out. All the inflows then listed vertically from periods 1 to 10. So these same inflows that we see horizontally in periods 1 to 10 now listed vertically from periods 1 to 10. So we're looking at the 80, the 97, and so on. The 80, the 97, 114, and so on. Then if we present value this down this way, using Excel, I would then present value the 300,000, even though it will result in the same value due to it being at time period 0, because that allows us to copy it down and have a uniform set of values in this column. Negative present value of the rate. Now we're at the cell 15, so that's the 15% absolute value on that cell, comma, number of periods is 0, referencing this cell instead of putting or typing in or hard coding the 0, comma, comma, future value, the 300,000, giving us the same result of 300,000 because we're at time period 0. Copying that down to period 2, the 80,000 discounted at 15%, 1 year back, 69,565, calculated thus. We have negative present value rate, B17, same B17 as above, absolute reference, comma, number of period, that B17 being the 15%, of course, comma, number of periods is now 1, which is referencing this cell, which has a 1 in it, which changed from AA2 to AA3 as we copied it down, comma, comma, because it's not an annuity, but present value of 1. Future value is the 80,000, which you can see once again copied down from AB2 to AB3. If we continue this process, then same kind of thing here. We got the 90,714 present value 2 years back at the 15% discount, 68,593. The 83,368.7 present valued at the 15% discount 3 years back, 54,815, and so on. Same results as we had in the horizontal fashion, and we get to the same result of the 59,551. Also note that if we sum up the column of payments without present valuing, after 10 years, we're looking at the 357,500 without present valuing, kind of net profit here. But that is deceiving. If you compare these two, it's a little bit deceiving because this 59,551 doesn't mean that that's what we got after, say, inflation, the cost, the decrease in the value of the money, because this 59,551 includes the fact that we have the 15% cleared, meaning even if this was 0, that would still mean that we cleared a 15% cost of capital, basically, return, which is in there. So you just got to keep that in mind as you're looking at these two. So we have the 59,551, meaning it's above 0 and therefore cleared the 15% cost of capital. But what is the rate of return? What is the internal rate of return? For that, we could calculate the IRR, which is the rate at which this present value series of payments would be 0, calculated as equals IRR, the range of the cells being the 300,000 down to the 45,500, would give us then the 20.78. Well, that's pretty good, 20.78% return. So that if we were to recalculate the net present value this way, present values, instead of using 15% discount rate, but using the internal rate of return, 20.78, we would get to 0 down below. because the internal rate of return is the rate at which the net present value would be zero, meaning that would be the internal rate of return, 20,000, 20.78% in this case.